Hi, everyone. Welcome to Credit Consulting Basics for Small Business Owners. We're glad you're here today. My name is Darlene Rose Schultz. I am a managing consultant for SBC Bookkeeping and Consulting. We are here working on behalf of the SSBCI program in Utah, and we're excited to share this information. I know that credit can sometimes be a daunting subject, so I hope that I can make you feel a little more confident as it relates to both personal and business credit today. Just one little housekeeping thing. Um, we're not able to interact with one another while the program is going on, but there is a question and answer uh, icon at the bottom of your screen that you can add questions to. And when we're finished with the presentation, providing there's time, we'll go through those questions and hopefully be able to answer them. So we'll go ahead and get started. So the first thing I want to talk about is what our goals are for the workshop. So by the end of this workshop, I'm hoping that you have some confidence as it relates to understanding the difference between personal and business credit, that you are able to find where you can actually access your credit report and review it with some confidence. You can identify and document if there's any inaccuracies on your credit report, and I'll walk through some steps you can take if you find that to be true. Understand actions that you can do quickly and over a period of time to support credit improvement. Understand how lenders evaluate credit and financial strength, and hopefully create a realistic, personalized credit action plan after we're done with this workshop for yourself so that you can pursue improving those credit scores if that needs to happen. So, important part of our presentation today is why are we here? Why does credit matter for small business owners? Well, I think that we're all pretty confident and aware of the fact that your credit can impact SBA loan approvals. It can impact eligibility for microloans through those programs, bank loans in general, lines of credit. We're aware of that. But I think it's also important to note that credit can impact other things as well. So it impacts interest rates and borrowing costs, how much it's going to cost you over the life of a loan. It can impact your insurance premiums, your business insurance premiums. It can impact vendor payments and how those payments work and what your arrangements are with your vendors. And of course, it can impact the ability to lease commercial properties and things of that nature, not only just for the actual property itself, but also equipment and things of that nature. So an important thought is a borrower who has, say, a 580 credit score will likely or may pay significantly more over the life of the loan as it relates to fees and interest and things of that nature than a borrower with a 720 score. So having the higher the score, the better the situation, not only for your ability to access credit, but also how much you pay once you have accessed it. So something to think about. Good credit can improve access to capital and can reduce borrowing costs. So we're going to talk about two kinds of credit today, your personal credit versus business credit. So what does that mean? Well, your personal credit is what is linked to your Social Security number. It is the information that relates to how you have, as a personal being, access loans, whether they be mortgages or car loans, credit cards, things of that nature. Personal credit is used by many lenders when evaluating small business owners. So when you go to access credit, they're not just looking at business credit, they are looking at your personal credit. So it's important to have a good handle on what that looks like for you. Your personal credit actually is just a reflection of your personal borrowing and repayment history. Business credit is linked to the EIN and the business identity. It is what is being tracked through business payment history. It is always important to have that separate business and personal finances so that you have those two kinds of credit. So depending on where you're at in the business cycle, if you are just starting out and you're just beginning to launch a business, make sure that you do have separate financial situation. So you have a separate bank account for your personal, your separate bank account for your business. Make sure to separate those things, credit cards, etc. It's just the best practice for business. It's important that you know that most small business owners will review both personal and business credit, as I've mentioned. So where do we get the credit report? We all have the ability to get our own credit report. One place to do that is at annualcreditreport.com. The nice thing about this product is that, first of all, it is free. You're able to access all three bureau reports, so your Equifax, your Experian, and your TransUnion, which is important to know what different items might be across those three different bureaus. So this will allow you to have all that information in one report, because information can differ. So annualcreditreport.com, though it says annual, I do think that you can access it much more often than annually. You can get it, I believe it is once a month, free, so that you continue to compare and contrast what you're finding. So there are two pieces to your credit history: your credit report and your credit score. We often say those as kind of one thing, but they truly are two different things. So your credit report is the detailed history of your borrowing and repayment activity on your personal credit report. Your credit score is the actual number associated. So one way to think of these two items is credit report is your financial report card. It's all that information, where your credit score is like your overall grade. Credit score models. So there's two different models that are used: the FICO, which is used by most lenders, and your Vantage score, which is used by some banks and credit monitoring services. Score ranges usually between 300 and 850. Interesting to note, average credit scores in the United States right now are 714 for FICO and 700 to 705 for Vantage score. So most people are falling in that 700 range. There are key credit score factors. So how does that credit score come about? What are they looking at? So there's 5 pieces that are being looked at when they look at your overall lending and repayment history. The first thing is your payment history. That's the 35% of the score is made up of, are you paying your obligations on time? 35%. The second aspect is your credit utilization. So that is the percentage of available credit that you're currently using. That's 30% of your score. And ironically, we would love to see that at 30% or below. So you can remember 30 as for both of those key pieces. The last 3 that make up the last 35% is going to be your length of credit history, your credit mix, and new credit inquiries. So your length of credit history is literally the amount of time you've held credit. The longer, the more you have in credit history, the better for your score. Your credit mix would be the different types of credit you have. So maybe you have some loans, you have some credit cards. The more of a mix you have, the higher the score for that 10%. And the new credit inquiries do come into play. We hear about soft pulls and hard pulls or hits. The lower the number of hard pulls, the higher the score for you. So when we're in this process and you might be looking to find ways to improve your credit, your best bet is to not try to access new credit, because that will lower that 10% of that score. So talking a little more about the credit utilization example, I mentioned that 30% or below is your goal for that utilization score. So for example, if you have one credit card that has a $10,000 limit on it and you're using 3,000 of that credit opportunity, that is 30% utilization. So our goal is 30% or below, so that would be within the range. Another example, if you have a $1,000 credit opportunity and you're utilizing, if you have that 10,000 credit card limit and you're using only 1,000 of that balance, then that's going to be 10%. So even better. The lower the utilization, the higher your score. So your goal is to get that to 30% or below. The reason that is because lower utilization often signals responsible credit management. It shows that even though I have availability to use all $10,000, I'm not. I'm being disciplined and using credit only as needed. There are many, many credit myths out there, but three that I wanted to mention today. The first one is checking your own credit lowers your score. That is, in fact, not the truth. You're doing soft pulls or soft inquiries when you're checking your score. So that is not going to have a negative impact on the amount on your credit inquiries. That is not going to be a problem. You can check your personal credit whenever you choose to do that. Another myth, closing old credit cards always helps. So you're working to lower your the amount of money that you owe in credit, and you get to the point that you have a zero balance on your credit cards and you decide, I'm just going to go ahead and close it. The reality is your better bet is to leave it open with a zero balance. The reason being is that the credit history that we talked about. If you've had that credit card for 10 years and it's now to zero balance and it's just sitting there, that's allowing you to have that 10-year credit history. So it's often better to leave that credit card open. And another myth is when you pay off a collection, it automatically comes off of your credit report. That is not necessarily true. In fact, it's not true. Things don't automatically happen. We're going to talk a little bit today about being in communication with your creditors. Paid collections will remain on your credit report. You can often work with them to perhaps make some adjustments to that, but it is not going to be an automatic. Just because you pay it off, it doesn't come off. It will show a zero balance, but it won't come off of your history. So in reading your credit report, there are several sections that you're going to come across on any of the bureaus that you're looking at. So it typically will include your first box or the top box, your personal identifying information. When you open your credit report, I want you to focus on that area first. Make sure that everything is spelled correctly, address is correct, information is correct, your social security number is correct. Everything that you're seeing that is personal identifying information about you is accurate. The next sections are going to be your account history, and those are kind of built up in blocks as well. So maybe you'll have a block that's a car loan and a block that's a credit card, a block that's a mortgage, whatever the case. And each of those account history blocks will show who the creditor is, will show what your limits are, what your balances are. It will show your payment activity. So oftentimes you'll see kind of a box that has X's and green check marks. The green check marks indicate under each month that you're correlating those check marks that you paid on time. And the X's, if you do have any red X's, that would indicate that you didn't pay on time or the payment wasn't made. So you can kind of see very quickly as a visual how you're doing with that particular account and what is being evaluated from a payment history standpoint. There's a section that you'll see collections and charge-offs. So if you have any of those are on there. And then there are public records, specifically like a bankruptcy. If that is applicable, you will see that on your credit report as well. Just a quick definition, if you see charge-off, a charge-off is when a creditor classifies a debt as a loss. There's been an extended period of non-payment, balance is still owed, it's still sitting there, but the creditor has decided to charge off. They're not pursuing it anymore. That does not mean you don't owe the money. That does not mean that it's not having a negative impact on you. It just means they're not pursuing it right now. So again, we're going to talk about this a little bit, but it is important to have a conversation with that creditor and see how you can make that right so that can ultimately help your credit as you go through. Okay, so we talked about, we're looking at this credit report. What are we looking for? Well, we want to make sure that everything is accurate. So the first thing that I always would suggest is if you're starting your journey to see how we can improve your credit or how you can improve your credit, have some kind of a tracking system in place. It is extremely important that you are organized and keeping track of what you find on your credit report. So this tracking system can be something as simple as a notebook and a pen and paper. That is perfectly acceptable. Put the date at the top, say I looked at my report and these are the things I found. I found some inaccuracies with this particular creditor, or my name was spelled wrong, or something to that effect. But what did I do today? Keep that tracking in a notebook so that you can continue to refer back. Spreadsheets also work great. So if you're comfortable creating spreadsheets, that would be something that you could create. This is the date I looked. These are the accounts that I found an issue with, whatever that issue may be. Here's what I plan to do. Here's what I've done. Here's who I talked to, etc. So again, you have it all in one place so that you have that documentation that you can start really starting to rebuild your credit and know who you've spoken with along the way. The reason we're doing this is not only for your own sanity, which I think is important, but also credit bureaus are going to require very clear, organized information if you are finding some disputes or if you are going to be asking for some help in some appeal situation. So having all of it in one place, always the best practice. So let's say you do find something. You find something on a credit report or for a credit card, for instance, that is just wrong information. It is an account that you did not take. It is an account that has a balance that doesn't match, doesn't make sense. It's not accurate. You are finding things that are literally not correct for a dispute purpose. You have the opportunity, if you find that to be true, to file a dispute. You can do that on the different bureaus that your Experian, TransUnion, etc. You can actually go to their site, go to the section of your report that shows an inaccuracy, and there are buttons that you can start filing a dispute. That is one opportunity that you can do that's fairly quick and easy. There's other ways you can do that as well. You can send one through the mail, which obviously can take longer. And then oftentimes you can do it on the actual creditors' websites and things as well. But probably the easiest, most effective way is just to go ahead and go to the bureau and file the online dispute. When you do that on your tracking, make sure you're keeping notes as to what you did. I disputed on this date. And the reason I say that is I want you to continue monitoring those responses. So typically about a 30-day loop, you'll go back, revisit, see if anything's changed on your report, see if there's anybody you need to follow up with, and then take notes of what that follow-up was. So a dispute is a formal request to review and correct anything that is inaccurate. Remember, incomplete or inaccurate. That's what a dispute is for. It should only be submitted if the information is inaccurate, incomplete, or unverifiable. We'll talk a little more about what happens if it's true here next. So if you find information on your report that is accurate, it's true, there's a period of time that you were not able to make your payments on time. Something was happening. As we say, life was lifing, right? Perhaps you were out of work or something was happening that just prevented you from being able to make those payments on time. And you can see on your credit report those X's during a certain period of time. You also can see that you now have some improvement. You've been able to pick up where you left off. You've been able to show that you are back on track with payment history, etc. In the event that this is true for you, there is an adjustment that you can request through the creditor called a goodwill adjustment. This would be something that you would gather some information for to kind of verify what you're asking and what you're saying. You would reach out to the particular creditor, again, probably through their website. You will find information on goodwill adjustments. They might have an email address specifically for this or phone number specifically for this. And you would reach out, have these conversations, knowing that the approval for this is entirely up to the creditor's discretion. It's not a guarantee, but it's worth a shot, right? So I always suggest, obviously the tracking again, make sure everything is in writing at least at first, and then go ahead and have those follow-up conversations and keeping track of who you talk to. Again, not guaranteed, but worth a shot. You want to start to see improvement with your credit. And if this is one way that could happen, just to show that you're improving and you've asked for this adjustment, and hopefully it'll be granted for you. Another opportunity, another adjustment, again, kind of similar to goodwill, only it's specific to medical. If you find the same situation, right? You had a period of time that things were just not being paid on time, or whatever the circumstance might be, and you know it's related to some kind of a medical hardship. You had to have surgery, you became ill, whatever the case may be that caused you to not make those perfect payments history time frame, you can request a medical hardship. Again, documentation is going to be key here. They may ask for medical documentation, so be prepared to provide that. And it can be done through the creditor's website. Looking for that information. Specific email addresses typically are the way to get that first in writing and then follow up with phone calls. So just to make sure that we're clear on the two different kinds of adjustment requests. A standard dispute, the information was not correct. It is not verifiable. It is inaccurate, and you want that changed based on that fact. Where a goodwill or medical dispute, the information is correct. You did have some payments that were not on time. It's extenuating circumstance that you're asking for, kind of throwing yourself on their mercy and asking for help to make those corrections on your report. So now we know that we've gone through, we've looked for inaccuracies, we've looked for something that could be disputable. We've asked and noticed times that maybe you could ask for a hardship request or goodwill request. The reality is now we've looked at everything, we've done all those, and there are still some things that there's just nothing else we can do except it's time to start figuring out how to clean up our credit. So if you find the negative information is accurate, you're focusing on, it's now time to focus on improving your payment consistency. Probably the most important thing, get that payment history in better line. You want to lower your outstanding balances, which is of course going to lower that credit utilization. Again, I think I mentioned earlier, but any new credit applications, you want to put a halt on that. Don't continue to apply for new credit because we want to keep those inquiries down. And using some kind of a structured debt repayment strategy might come into play here to help you get some of those payments down and your balances, or balances down and payment up. So two of those debt repayment strategies we can talk about right now. So the first one is the debt snowball method. Both of the ones that I'm going to talk about today require these steps. We look at our credit report, we list out all of the, say, credit card accounts that we have open. First things first. And on that list, you look at the amount of money that you owe on each of them, what your credit limit is on those, and your interest rates. For the snowball method, once you've done that, then you put in order the lowest balance, your smallest balance first, in order up to your largest balance. Then you determine what is the total amount of minimum payment for all of those accounts. What is the total? So let's say the total is $200 a month in minimum payments. But you know that you can confidently throw a total of $350 a month towards your credit. So what you will do with the snowball method is, starting with your smallest balance at the top, you will pay all of your minimum payments first for each of your cards. And then anything left, and in this case, it would be another $150 that you're going to apply towards your credit. You will take that extra $150 after you've paid all the minimums, and you will pay that towards your smallest balance until your smallest balance card is at zero. And then you go to the next one, and so on and so forth. This particular debt reduction strategy helps for those of us that are motivated by seeing those payments or seeing those accounts be paid off quickly. If that's your mindset, this is the method for you. The other method is called the avalanche method. Again, same steps, listing your accounts, your credit card accounts, listing your balances, etc. But the only difference is, after you've determined how much money all the minimums are and how much money you're planning on using to pay down your credit each month, instead of using the smallest balance, you're going to go to the highest interest rate. You're going to pay that off first and then go down your list. This strategy helps, it maximizes long-term savings. It will also reduce your total interest paid over time. So those of you are or us that are focused on minimizing interest cost, this is the strategy for you. Both are very effective. If you do find that you have collections and charge-offs on your account, you can and should reach out to the creditor or this where you have those collections and charge-offs and ask them what you can do. You may negotiate a settlement with them, create a payment plan, request for some kind of an account resolution, but you have to have that communication. It is sitting there and it is hurting you. It is not money that they've just decided they're not going to, or they might not be trying to get the money now, but it's still affecting you in the long run. It's still money that is owed. So have those conversations. A collection account is a debt that was transferred perhaps by one creditor to another. Maybe it goes to a third party collector after non-payment. So your key reminder is always obtain written confirmation of any agreement before submitting payment. So when you're having these conversations with these creditors, if you've negotiated a settlement or a payment plan, make sure you get that in writing before you start the process. That way that protects you and it protects them. Another strategy that is great over and above just looking at your credit reports is setting up some kind of a credit monitoring system. There's a lot out there. We've all heard of Credit Karma. That would be one opportunity. Most credit cards have that opportunity, and most of our bank accounts do as well. So you can just choose which one works best for you. It will give you notifications if there are new accounts added to your profile, if there are new inquiries, like those hard inquiries we talked about, those will come up in notifications. And it also allows you to be keyed in if there's any fraud going on. If you're getting notifications that you had nothing to do with, you'll know that you need to start addressing some things. As we've talked about before, with that monitoring of inquiries, a hard inquiry is something that's initiated by a lender, and that will temporarily impact your score. So obviously, if you have credit monitoring in place and you know for a fact you haven't been asking for credit and you see something like that, you can attack that right away. Another good strategy when you're going through the process of trying to improve your credit is setting up technology and automation. I'm having a hard time with that word lately for some reason, automation. So obviously the credit monitoring alerts we've talked about, having those tracking spreadsheets, getting those in place. Another important thing when we're trying to improve our credit is making sure we're consistent. So this can be kind of an overwhelming process. We don't want to have to think about it every minute of every day. So make some calendar reminders, set an appointment with yourself and say once a month or once every 2 weeks or whatever cadence you decide is when I'm going to address my credit situation this month. Know that it's on your calendar, know that you're going to keep that appointment, and then don't worry about it all the rest of the month, right? Just know that you're going to have that appointment and keep it. So calendar reminders are a really good piece of that puzzle. Also, calendar reminders can be very helpful if you want to make sure that you're paying payments on time. So just go ahead and set on your calendar that on the 3rd of every month, I'm going to pay this bill. You get a reminder, you pay it. It's not something you have to be constantly thinking about because you know you have a system in place. So technology and automation is a great way to keep your consistency, because consistency is often what drives your long-term results. This is a process, so being consistent is your best method. In addition to the things we've mentioned, there are some credit rebuilding tools out there. One kind of tool is going to be a secured credit card or a secured credit builder loan. Both of these work very similarly. One product out there, I believe, is called Self. That's one you can look at. But basically what you do is you deposit a refundable deposit into your either secured credit card account or a credit builder loan account. Let's say it's $500. So you're basically lending $500 to yourself. You then use your credit card or use that $500 loan for whatever you need to use it for. and then you begin the repayment process. So for the credit card, you make that monthly payment every month, just like you would a regular credit card, except it's your money you're using. But they are reporting to the credit bureaus that you're making those payments on time. Same thing with the credit loan option. So basically, you're proving that given the opportunity for the $500 credit that you're being offered, that you're going to pay those payments on time. And after a designated period of time, 12 months or whatever the terms are that you agree with this service, they'll then give you back the $500, providing that you've made the payments that you're supposed to make and you have a zero balance. And now you have better credit to show. And hopefully that will allow you to access a non-secured credit card or loan that you can continue building that process. So that is a good avenue for those of us that are trying to rebuild credit while we're in unison with the other items that you're doing, which is your payment history and reducing utilization, et cetera. There's also another product out there called Experian Boost. What this does is it allows those monthly payments that we make that are typically not reported to bureaus, will allow them to be reported. So it depends on what you're doing from a standpoint of like phone bills, utility bills, maybe you rent. Those are typically not reported, but if you go through Experian Boost, if you make payments to services or to organizations that are on their list, they will connect to those accounts, see that you're paying on time, and they will report to the bureaus for you. So that will also have a positive impact on payment history and ultimately a positive impact on your score. Okay, I think it's always important to be realistic. So as you're approaching this, it's good to know what your credit improvement timeline is. Unfortunately, and I wish I could report something different, but it's not instant by any stretch. So knowing that these typical timelines might be helpful to you to know it's more of it's a process versus a quick fix. So usually for correction of reporting errors or reduced balances, you're looking at about a 30 to 45 day period of time before you see a difference in your score. For making those consistent on-time payments and lowering your utilization, typically between 2 to 3 months, you start to see that impact your score. And then continuing to establish positive payment patterns and improving your credit mix, 6 to 12 months, you'll start to see a score improvement. It's important to address inaccuracies, lower your utilization, and knowing that those are commonly among the earliest area of improvement. So you're addressing inaccuracies and lowering utilization are where you're going to see the quickest fix for that credit report or credit number. This is not necessarily a fun process, but or an easy process, but it's an important one. So as you're seeing these improvements over time, take time to celebrate that progress. Be happy when you see a score improvement or resolved reporting error, reduced balances, you're settling some accounts. Every small improvement you're making is creating a meaningful long-term result. So be good to yourself, give yourself grace, and be happy when you are succeeding at the goals that you're setting for yourself. Okay, so we talked about personal. Let's talk about business now. So again, we mentioned personal credit associated with your social security number, your personal credit habits. Business, more associated with your EIN number and your business itself. Obviously, depending on where you are in the business process, you might not have established any credit yet, which is perfectly fine, but there are ways that you could do that. So first and foremost, we want things separate. We want business credit separate from our personal credit. We want business finances separate from our personal finances. Mingling is not our goal. We want them separated. It helps with credit. It helps with financial tracking. It helps with taxes. It's just extremely important to have those separated. Okay, so how do we establish some business credit identity early, right? Well, the first thing is we're going to establish professional business presence. So if you've been in business for a bit, you've probably already done this, right? Some of these steps you've already taken. You have a business address, you have a phone number, a website, and an email. business is separate from you. It's a separate entity, and you're establishing that. It's something that could be seen. An EIN registration. Again, if you've been in business for a minute, you have established an EIN. You've established a business bank account, hopefully. If you haven't, you want to make sure you do that. But that's another piece of building business credit. Getting a business credit card is an option. So maybe they're definitely going to look at your personal credit, but you get a card that has the business name on it and you're using it for business purposes only, and you're paying it on time and you're keeping that utilization down. That's going to help to build your business credit. And another option is to go to Duns and Bradstreet and get a Duns number. It is a unique identifier that's used to track business credit activity. So that is an option for you as well. So back to just kind of going through that roadmap. You're going to establish a business entity. You're going to get your EIN if you haven't already. You're going to get a business bank account and obtain a DUNS number. Another option would be to establish vendor trade lines. So you are a business that you are needing to purchase things from vendors, whether they be office supplies or raw materials for products, whatever the case may be. You're working with vendors. Some vendors will report payment history to credit bureaus. So something to have a conversation with and see if they do. That's an option. Obviously, the business credit card, like we talked about, and it's important on this roadmap to monitor your business credit reports as well, which you can do through Duns and Bradstreet. To strengthen your business credit, you can register with reporting agencies, which are mentioned below, that Dun & Bradstreet, again, Experian Business, Equifax Business. Again, open reporting vendor accounts, have those conversations, see if the vendors that you're using do report and ask that they do, or if you have to choose between several different vendors for the same kind of products and they're pretty equal across the board as far as costs is concerned, et cetera, you might want to go with the one that says they report to bureaus. That's only going to help you in the long run. It's another positive check mark for that vendor. And then, of course, you're monitoring credit reports. So, again, you can go to reporting agencies, Dun & Bradstreet, Experian Business, and Equifax Business to monitor those reports. Just to give you an example of some vendors that did report to reporting agencies, at least the time that this presentation was created. These are office suppliers, but Uline, Grainger, Quill, Summa Office Supplies, these all have been known to report to bureaus. So if these are vendors that you use, you may want to have that conversation. And it's also important to note that some vendors are reporting and then they stop reporting, or have never reported and start to report. So that's a conversation you can continue to have every now and again with your vendors, just to see. And obviously, if they're willing to do that, you would ask them to report for you. So how does all of this impact our ability to get a business loan? SBA lending is evolving. It always is evolving. And it's not just specifically looking only at your automated credit score to make a decision. SBA loans, SBA lenders are looking at the full package. Your credit number is important. It never isn't important. You want to get that as high as you can. But also know that lenders are also probably going to evaluate, like we mentioned, your personal and business credit. They're going to look at your business's cash flow and your banking activity. Any financial statements, they're definitely going to be looking at those, whether they be established financial statements, or if you are just a startup, maybe your financial projections, realistic projections, they're going to look at those. They're going to look at industry and management experience for the industry that you're in. They want to know that you have a firm understanding of what you do and you have a background for it. They are going to likely look at your time in business, or if you're a startup, that isn't accurate, obviously, but they're going to look at the industry overall for that. And they're going to want a strong business plan. So if you don't have one in place, whether you're already in business or you're getting ready to start, a strong business plan is so important. So do focus on that piece as well. And they want to know that you have the ability to repay the debt. So debt repayment capacity, they're going to be looking at all those financial pieces to make sure that your business is going to allow you the opportunity to pay the debt back. So remember that a strong credit score is always important. Lenders are going to look at that, and that credit score is going to open the door, but your cash flow and your ability to repay is going to secure the approval. So your best foot forward is to have a really solid package put together, which would mention the items that we just talked about. Another suggestion that I make to my clients before they have the funding conversation is to understand that there are different kinds of lenders out there that are associated with SBA lending. And it is okay. In fact, it's not just okay, but it is advisable that you have conversations with more than one lender. So oftentimes we would suggest that you start with who you have a banking account with for your business, see what their lending policies are, but look at a couple of other options as well. And when you have those conversations, remember some things. Different lenders tend to use different data sources. So that's going to be a conversation you want to have with specific lenders that you're talking about. But as a general rule, major banks often rely heavily on credit reports and financial statements, where credit unions may emphasize more relationships and repayment capacity. Not that they don't all look at repayment capacity, but that might be a bigger focus. And then alternative lenders like CDFIs, for instance, they're going to really look at your cash flow, your business activity, your business credit. So it's important to have the conversations, and you're well within your rights to do that. Find out ahead of time before you start pulling the trigger on this, what is the particular lender that you want to work with looking for, so you make sure that you have those pieces in place before you start the process. So some red flags to consider as you're working through this. If you come across an organization that tells you that credit repair is guaranteed, that might be a red flag. You might need to do some more vetting. Nothing is guaranteed. You're going to put in the work and you're going to see results. But if somebody is telling you, do this, this, and this, pay me for it, and I promise you a guarantee that your credit repair, that is something to consider vetting before you move forward. Again, that would be the same thing with instant score increases. We've already talked about the fact this is a process and it does take time. So nothing is instant. If someone's telling you it's instant, pay me and I'll make it instant, that's probably a red flag. And also, don't pay upfront fees without written agreements. Make sure that everyone in the scenario is covered and safe before you make any decisions moving forward. It's important to note, obviously, just in this realm, as in any realm in our lives, if an offer sounds too good to be true, it probably is. So just continue to do the vetting and make sure that you understand all of the aspects before you make any decisions moving forward. And best practices, always, always, always remember, never dispute accurate information, only dispute inaccurate. Avoid excessive credit applications. In fact, I would just put a halt to them completely if you're improving your credit, if your goal is to improve credit right now. Avoid late payments whenever possible. So that needs to be the focus. Just pay them on time. Even if you're just paying the minimum, obviously we want you to pay more, but make sure you're paying it on time no matter what you do. And do stay in contact with your creditors if you're struggling. Communication is key here. It can be a very uncomfortable feeling to have conversations with creditors, but it is a very important piece. Stay in communication. Call them every month if you need to. Make sure they know where you're at and what your goals are and what your plan is, and let them make those notes for you. Resources that we've mentioned throughout that I wanted on one slide for you. Annualcreditreport.com is where you can get that credit report. I would do that soon if you haven't already, or if you haven't looked at one in a while. SBA.gov has some great credit information. Dun & Bradstreet, where you can get your DUNS number. And then the consumerfinance.gov is also a great resource for good information for credit improvement, credit reports, etc. So if your thought is, okay, I'm ready to tackle, what do I do next? Well, I've got two slides here. My first one is a 90-day credit improvement challenge. And what I really want you to see when you look at this is not the specifics necessarily, because the specifics might be different for each of us, but that you should, this is a process, and it's okay to say, month one, I'm going to do this, month two, I'm going to do this. So month one, at the very least, get your credit report and review it. see if there's any inaccuracies, and then start deciding how you're going to pursue that. Month two, work to reduce your utilization if utilization is a problem, and address any outstanding issues that you found last month that you're working towards from an inaccuracy point of view. Month three, focus on that building that positive payment history. If you have not already, make sure you're making those payments every month on time as prescribed, and continue to monitor your progress so that you can be happy when you're making positive changes. Your goal is to create sustainable credit improvement habits. Project progress is often measured in months, not days. It's a process. Sorry, I keep saying it, but it's the truth. Go easy on yourself. Know it's going to take some time, but months and months are going to pass whether you're doing this or not. So if it takes 6 months to see improvement, 6 months going to pass. If you're doing these steps, 6 months from now, you're going to see improvement. That's the goal, to see that number go up. What can you do now? And then within the next 7 days, if you choose to do so, pull your credit reports. You can do that this week. Set up some monitoring through a credit card, through your business account, through Credit Karma, if you choose to do so. Find those potential inaccuracies and make a plan for what you're going to do for those. Contact one creditor if you have one out there, or if you have several out there, or you have one out there that needs some communication. Put it on your calendar. Reach out to them. Give yourself some time to do that. And reduce one balance. You're going to see some improvement over a period of time if you start reducing those balances. Small actions taken consistently can produce meaningful results over time. And I also want to introduce to you the fact that we are a business technical support provider for the SSBCI program in Utah. And there is a free option for you to experience one-on-one business consulting through this program. If that is something you're interested in, you want someone to sit down and have a conversation with you about credit improvement so that because you're working towards funding. You want some information about how to put some financial projections together, or just overall financial health. You have that opportunity through this program at no cost to you. So if that's something that's interesting to you, you can learn more at utssbci.com. Or you can also go to send an email to utah@sbcfirst.com. And if you are approved or eligible for the program, we'll reach out to you and we'll get you in touch with a consultant so you can get started on some technical assistance. So that is what I have for you today. If you have any questions, we can look at that question and answer section if anyone's put anything in. Let's see. It doesn't look like there's any questions right now. If anyone has any, I'll be on here for a few minutes. Otherwise, thank you so much for coming. I hope this was good information for you. I hope that you'll take advantage of the SSBCI Technical Assistant Program. Maybe we'll come in contact again on a one-on-one basis. I hope you all have a wonderful day, and thanks again for joining.